In this video, we're going to go through a CFA Level 1 style question on the revaluation model. And this is, in fact, part 1 of what is a two-part question. So please stay tuned for the next recording, especially as the revaluation model and its consequences get plenty of candidates completely confused. So if this is something you want to get right in the exam, keep watching. And let's get solving. So, this is the question that I want you to have a go at. Cerberus Manufacturing, a company reporting under IFRS, uses the revaluation model to account for its land and buildings. On the 1st of January 2020, the company acquired a plot of land for €3 million. If, at the end of the 2 annual periods following the acquisition, the fair value of the plot is determined to be, on the 31st of December 2020, €3.5 million, and on the 31st of December 2021, €2.8 million, which of the following best describes the impact of the plot's fair value changes on the company's other comprehensive income for the year 2021? And we've got 0.7 million loss, 0.5 million loss, or C, no impact. Okay, let's start with a little theory. Under IFRS, companies may choose between two models for computing the carrying amount of their property, plant, and equipment. And the choice is between what's known as the cost model and the revaluation model. It's perhaps worth mentioning that this choice also applies to certain intangible assets, but there are additional considerations and criteria which need to be met, and they are quite prohibitive, so you won't realistically see that many intangible assets measured under any other approach than the classic cost model. So, the cost model is the standard approach under which an asset's carrying amount equals its historical cost less accumulated depreciation. And potentially impairment losses as well, but let's ignore these for the sake of simplicity. On the other hand, under the revaluation model, an asset's carrying amount is going to equal its fair value at the date of the most recent revaluation minus any subsequent depreciation. And before we get cracking with the scenario, let me also emphasize that the choice between the cost model and the revaluation model does not need to be made for the entire property, plant, and equipment category as a whole. The revaluation model may in fact be used selectively, for example, just in respect of some classes of assets within PPE, for example, just for land or land and buildings, whereas other PPE items such as fixtures and fittings, vehicles, tools and machinery and so on may be measured under the traditional cost model, naturally, if that's what the company wants to do. And one more thing to remember. The revaluation model is not allowed under US GAAP. Please remember that. So, in this question, we are dealing with a plot of land, which is nice and handy because land is typically not depreciated, which is one thing less to worry about. Anyway, we are told that the plot was acquired on the 1st of January 2020 for €3 million, and that it subsequently increased in value to €3.5 million by the end of the year. Now, if the asset were measured under the cost model, this increase in value would have no impact on the company's financial statements at all. However, under the revaluation model, we are supposed to carry the asset at its fair value from the most recent revaluation. And let me now show you how this works from an overall financial statements perspective. We've got our plot of land sitting on the PPE over here within assets, and it is initially recorded at 3 million euro. By the end of the year 2020, this gets adjusted upwards by 500,000 to reach a new level of 3.5 million. Naturally, increasing the asset side of the balance sheet necessitates an equal move on the right-hand side over here. And I'm going to record that upward 500,000 entry within equity under the heading Revaluation Surplus, which is also known as the Revaluation Reserve. Now, it is really important to appreciate that if a revaluation initially increases the carrying amount of an asset, it does not go to P&L. So let me over here in this column for 2020 draw a cross to emphasize this. In other words, it does not feature in the computation of reported earnings. It is, however, treated as a gain, just not a gain that would be reported within income. And you should be aware of the fact that all gains and losses which bypass the income statement are presented within other comprehensive income, or OCI. So let me make a positive 0.5 million entry over here and show that it corresponds to this increase of the same magnitude within equity. Back to the previous view, let's note that this growth of 500,000 is indeed recorded within OCI. And let me also add that if the asset's fair value were to grow further, we would continue doing the same thing again and again, increase the carrying amount and keep pumping the revaluation surplus with each increase showing within other comprehensive income. However, this is not the case. At the end of 2021, the plot's fair value is just 2.8 million. So it will now require a downward revaluation. So let's once again revert to this financial statements template view. In 2021, so that's this column, the assets carrying amount drops to 2.8 million. So that's a drop of 0.7 million euro. And this will be accompanied by a reduction in revaluation surplus over here. But as the name surplus suggests, this can only be a positive item, i.e. we cannot deplete it beyond what is already sitting here, and that is 500,000. So we reduce revaluation surplus down to 0, and that's going to be a reduction of 0.5 million down to 0, as I just said, and that triggers a negative entry within OCI over here. Remember, the role of other comprehensive income is to record all gains and losses, as is going to be the case right now, that bypass the income statement. However, any further losses, that is losses which go beyond merely reversing the previous positive entry of 500,000 in revaluation surplus, will need to go to P&L. So let's record this. A negative 0.5 million entry to OCI in the 2021 column. This, as I said, corresponds to what we have already done to revaluation surplus. So as you can see, the role of OCI is to reflect pretty much what we are doing to revaluation surplus within equity. However, we also need an additional 0.2 million over here within P&L. So a negative entry to P&L of minus 0.2 million. And this will naturally impact equity as well. Anything that is taken to P&L, either with a plus or with a minus, does ultimately impact equity. But instead of being shown as part of revaluation surplus or revaluation reserve, this will be reflected within retained earnings, as generally this is the place where we take the net income that is the product of our P&L computations. Okay, all in all, these two entries, so let me just make sure that I've got this minus 0.2 or reduction of 0.2 million. All in all, what we've got is a balance within the balance sheet, 0.7 negative or drop to the asset value on the left-hand side of the balance sheet. And in a similar manner, when we add what was taken to revaluation surplus and what impacted retained earnings, both downward arrows, we have a total negative impact of 0.7 to equity, so the right-hand side of the balance sheet. And back once again to my note view. Let's draw what happens in 2021 as consisting of two separate drops. 500,000, which is presented within other comprehensive income, OCI, and an additional 0.2 million drop, which goes to P&L. With the overall result that the assets carrying amount is reduced to 2.8 million. Let's go back to the question and check what it was actually asking us for. Which of the following best describes the impact of the plot's fair value change on the company's other comprehensive income for the year 2021? And it is naturally 0.5 million, which corresponds with answer B.